Hi, I'm Sam Slater from Fund Calibre, and today I'm joined by James Thomson, manager of Rathbone Global Opportunities Fund. Hi, James.
Hi, Sam.
So can you tell us what type of company you look for in the portfolio, please?
Well, I run the Rathbone Global Opportunities Fund. It's a global stock picking fund. I'm looking for under-the-radar or out-of-favor growth companies. The companies that I'm looking for are companies that are doing something a little bit different. They're innovative, they're shaking up their industries, they're growing quickly, both their revenues and their returns for shareholders. I've been doing it for the last 16 years, and on average, I've returned just above 13% per year. Now, that is an average. Some years have been higher and some years have been negative, so it's not always a smooth ride, but I think it's an exciting global equity fund for long-term investors.
And do you tend to stick to companies in developed markets rather than emerging markets? Why is that, and have there ever been any exceptions?
Yes, that's right. Really, at the beginning of my career, I spent quite a lot of time going on trips and conferences to emerging markets, places like India and China, Russia. I even went to Mongolia and North Korea.
Okay.
And I always came back from those trips feeling that I was at a disadvantage. A disadvantage perhaps to local fund managers who had much greater detail and knowledge. And so I felt if it wasn't a level playing field, I shouldn't invest. And really, since then, and for more than a decade, I haven't invested directly in emerging markets. So that means companies listed in Shanghai, Mumbai, or Moscow. But of course, I invest in developed market companies that have underlying exposure to emerging markets. And I think it's actually quite difficult to find a company that does not either source from or sell into emerging markets. So you do have indirect emerging market exposure, but just not the highest risk investments in emerging markets. I don't really make exceptions unless you consider Hong Kong. I have one single investment in Hong Kong, which many ratings agencies believe is a developed market, although the underlying business is highly exposed to China.
And do you have a defensive bucket as well in the portfolio? What's that for, and what type of company do you have in it?
Yeah, so I've run the fund for 16 years, and there really haven't been any changes except one. After the 2008 financial crisis, I performed dreadfully that year. And I realized that I needed to get better. I needed to be a better fund manager, and my process needed to change. I needed to think more about managing risk, more balance and diversity. Not just companies that are economically sensitive, but companies that have a more defensive, resilient, reliable business model. And so after 2008, I said anything between 15 and 25% of the fund should be in these sort of weatherproof companies, these companies that aren't at the mercy of the economic cycle. And so that could be businesses in healthcare or food and beverage and ingredients companies, companies where the economic sensitivity is much more low. And so at the moment, we've got about 20% of the fund in that area. It won't shoot the lights out in a bull market, but should provide a bit of a buffer in more difficult times.
And you've been pretty positive on the US in recent years. Are you still positive, and what's your view in the run-up to the election?
Yes, I am still positive. I have over 60% of the fund invested in the US. I would say even despite the ugly politics, I like the US because that's where we really find some innovative, differentiated, sustainable growth companies. And that's really, the US is where the growth is. US companies are growing profits 4 times faster than the rest of the developed world. Now, of course, this is an election year, so there could be additional volatility from that election. I think actually market participants are most worried about a progressive Democrat winning the US election. I think it's probably unlikely. Remember that US elections are won by swing voters in swing states. Those are the same voters that voted for Trump in 2016. And so I think it's unlikely that that Trump voter would swing all the way from right to far left to vote for a progressive Democrat. So I think the most likely outcome is a centrist Democrat or Trump winning the election again. But overall, I think investors overemphasize the impact of politics on stock markets, at least in the long term.
And something that we ask a lot of Asian equity managers and even European equity managers now when we meet them is around trade wars and what the impact's been. What's your view on trade wars from a US or even a global perspective?
I think the trade war, which really came to a truce late last year, was probably the greatest headwind for the global economy and actually the US economy in particular. We saw profits in the US depressed in the S&P 500 by about 7 or 8 percentage points, according to one analyst at JP Morgan. So that is a very meaningful headwind to profit growth. But of course, as we started to get towards the end of the year and it appeared that that trade war truce was coming, stock markets started to discount that and started to rise quite sharply. Now, as we enter 2020, perhaps we're unencumbered now with that. Or maybe Trump will turn his crosshairs to a different trade war, and that could be a risk as we go into the election.
And in contrast to the US, you've been quite negative on the UK in recent years. Now that we've got the election out of the way, a little bit more clarity around Brexit, has your view changed?
Yes, the UK is back on the menu again for me, but it's not an all-you-can-eat buffet. When the Brexit referendum passed 3.5 years ago, I significantly reduced my weighting to the UK from about 24% of the fund down to a low of 4%. And that's because I just didn't know how Brexit was going to play out. There were clouds of uncertainty hanging over the UK. But with the general election result, the certainty is increasing. And remember that valuations are a reflection of the change in financial conditions. And financial conditions have improved in the UK. And so that deserves a higher multiple as investors get more confident. And really, the UK has been a pariah for many years. I've heard many stories of analysts traveling all over the world, pitching ideas to fund managers like me. And fund managers say, don't want to hear about the UK, not interested. I think that's changing. And we've actually started to see some early evidence of that. There have been some CFO studies coming out recently, and the survey results have pointed to much higher confidence about their financial outlook. Business investment has been delayed terribly for the last few years. That is starting to come back. Investor sentiment is starting to improve as well. And so I think that's a much better cocktail for UK PLC. And so, yes, I have started to increase my UK exposure for the first time in years. I've added to some of my existing holdings, and I've bought a new holding in the UK, and I'm looking for more.
Thank you.
Thank you, Sam.
If you'd like to find out more about Rathbone Global Opportunities Fund, please go to fundcalibre.com.